China triggers the new circuit breakers and closes early, down almost 7%. Good morning and welcome to this edition of IG Live on Monday, the 4th of January 2016. I hope you had a good weekend. 2016 has started with a shocker in China as Chinese PMI data alerts the world to the local slowdown. And as tensions mount between Saudi Arabia and Iran, oil kicks off 2016 with a near 2% rise. Asia Pacific markets, the Nikkei 225 down 3%. Shenzhen, as I said, down almost 7% on the trading day on a foreshortened trading session because of the circuit breaker triggered today. S&P ASX 200 down almost 0.5%. So that's how things have started out on this first trading day, first big full trading day of 2016. Let's go over now to our Melbourne newsroom, where our market analyst Angus Nicholson is with us with more of what's been happening on the markets overnight in Asia.
The first session of 2016 for most markets has been very volatile already. Volumes, of course, are still pretty low around the world, but it has been some dramatic moves over the weekend and also with the data flow in Asia today. Announcements that Saudi Arabia had executed a Shia cleric and that Iranian protesters had burnt down the Saudi Arabian embassy, and then that diplomatic ties had now been cut between the two countries has sent a major rally in the oil price in the Asian session here. That has really helped move energy stocks upwards, and initially that move seemed to be a positive in that it was lessening some of the pressure on the high-yield bond sector, with US futures moving up strongly earlier in the Asian session. However, this was not to last for the rest of the day, with the Chinese currency fix coming out much weaker today, with now a 0.5% weakening in the currency midpoint over the past 5 days, which saw some major moves in currencies globally, leading to a lot of US dollar buying as moves were as US dollars were bought and Chinese CNY was sold. We saw that movement happening across a range of currencies globally. And then we had the Chinese Taishin manufacturing PMI release today, which came in far below consensus estimates for about a 48.9 reading. It came in at 48.2, much lower even than the previous month of 48.6. Now, what this seems to be driven by is a lack of credit getting to the small and medium enterprises in China, which dominate the Taishin index, unlike the MBS PMI, which was released on the 1st, which did see some improvement, largely driven by the fact that large enterprises are getting better access to state-directed credit. Nonetheless, that big miss in the Chinese Taishin PMI alongside the weakening in the CNY seems to have driven some real concerns in the Asian session, and particularly over in the Chinese markets, which are seeing some of their worst sell-offs in many weeks. Significant selling in all the mainland indices and also the Hong Kong markets. But this has been mirrored across the region, with the Japanese markets down by over 2% as well. The ASX is also in negative territory, but compared to China and Japanese markets has held up far better, much of that driven by strong moves in healthcare and energy stocks today. But the lack of buying in the banks and indeed the negative performance by the banks on the ASX has been one of the major contributing factors to the poor performance of the index. But it hasn't been infected with the concern that we are seeing in the rest of Asia. And there has been a noticeable rally in the Japanese yen today, some significant safe haven buying over China growth concerns leading into 2016. Of course, we will see a drop-off in the Chinese data as it closes down for the Chinese New Year at the end of January and into February. And those concerns and this consistent seasonal drop-off in Chinese economic data in the first quarter of the year are certainly growing to concerns about what 2016 might hold for the pivotal Chinese economy this year.
Angus, thanks so much indeed. So that's the way that 2016 has started in the Asian markets, and we are, as we've just explained, looking for a weaker start when things get underway here in the European markets in about 5 minutes' time. It's not just that issue, it's also concerns about the US as well, that interest rate rise that we saw in December. John Williams, who's the San Francisco Fed, is now raising some sort of concern about that, and he'll be talking a little bit later on today. So that's something else that the markets have also got to think about. David Madden is with us. Good morning to you. First of all, why does Europe worry about what's happening in China, which is still, after all, a relatively heavily regulated market? Yes, it's put in these circuit breakers to sort of try and stem the flows that we saw perhaps maybe last August and so forth in these equity markets. Nonetheless, the stock market, they're down 7% today. Why should we worry here about Chinese manufacturing PMI?
Well, it's the same old story from last year. Mining companies, effectively, and to a lesser extent, oil and gas companies. China's manufacturing sector still remains in contraction. The figures from the private survey came in worse than expected, it's remaining in contraction territory. We saw a major sell-off in high-grade copper on the back of this, down 2.5% on the trading session. And even though mining companies were a major story at the back end of last year, they still continue to be a big story for 2016. And seeing as the FTSE 100 has a relatively large proportion of mining companies, that's obviously going to be weighing on the FTSE itself. And the mining sector and the FTSE 350 mining sector is going to be under pressure this morning, as are all the individual components: Rio Tinto, BHP Billiton, Anglo American, and of course Glencore.
And of course that's one reason why the FTSE was down 4.9% last year, rather than the 8-9% rise that we saw both in the DAX and the French markets. It's interesting to see, though, you talk there a lot about the mining companies, but nonetheless, there's a lot of contagion as well for Europe as well today. We've got the DAX at the moment down 1.75%. So it seems like it's almost a Europe-wide effect.
It really is. The financial markets move in tandem, and if the stock market of the second largest economy in the world moves down 7%, and has to be effectively hit the circuit breaker and shut down, it really sends a negative message. On top of that, even though China is a major importer of all the precious metals and base metals, it's also deliberately moving away from heavy manufacturing and towards a service-based economy. So we are seeing China being a major importer of Western luxury goods, be it cars in Germany or be it handbags from London. These are the sort of products and these are the sort of companies which are listed in the West, which do a lot of business with China. Any kind of sign that China is very much slowing down or else starting off 2016 on the wrong foot is obviously going to have a negative impact on the major companies which export to China.